In this video, I'm going to share 10 reasons why you have the advantage over large institutions, hedge funds, all these places that I think a lot of investors think, oh, well, how the hell am I supposed to be those guys? You have the advantage. Let me explain why. If I can just pull my screen up. So the first reason is that models assume that the future behaves like the past because the past gives you data and data gives large institutions confidence, which by the way is a reasonable assumption because they are trying to be safe. They are not trying to take huge gambles and huge risks. They want to be safe. They want things to be provable, mathematically aligned. For example, economics as a subject is very mathematical heavy these days. And so the whole idea of modeling is really integral to basically anyone who is trying to forecast the economy, trying to forecast stocks. Like, it's very, very methodical. And by the way, that's not a bad thing. But to achieve those outsized returns, right, often it involves going a little deeper than that. So again, I've kind of said that institutions rely on historical data, but the biggest moves often come from regime shifts and not averages. A lot of these models are using averages a lot of the time. That's not bad, but the averages miss the distributional data within. So examples, value at risk models assume normal volatility, and then 2008 once in 10,000 year crash happens. Inflation models assumed disinflation, and then 2021 to 2022 blew them up. No past data on AI adoption or crypto, and therefore models had nothing to latch onto. They had nothing to focus on. So why does this matter? Well, it means if the next move is structurally new, then models literally cannot see it until after it happens. This is really important because it means if you specialize on spotting things that are new and have a process that you can identify and quantify, or even just qualitatively be like, okay, this is something that's good. This is something that makes sense to me. That is an area where by definition you can get an edge on the crowd or the smart money because you are doing something that their models will not allow. Next point about models. Models are built on consensus assumptions. They all use the same frameworks and pass them between institutions. This is also tied into the idea that a lot of these people have gone through the same academic process. Again, not a bad process, but it teaches everybody to think about things in the same way. They process information the same way. They go through the same models. And therefore, if everyone is looking at the same information in the same way, then how on earth could you expect to have an idea that goes against the crowd? You can't and you won't. Examples. DCF, which stands for discounted cash flow models, assume mean reversion. This is something used in stocks. Macro models assume Phillips curve. Risk models assume diversification works. So when the assumption fails, everyone is wrong simultaneously. Again, similar to if everyone is positioned on one side and then something happens, whether that be before a recession on a slightly more macro perspective or on a smaller scale where everyone's really confident about a stock and then a surprise comes out that's negative that probably could have been seen if they weren't so bullish on the company, that sort of thing. And so a blind spot here that emerges is consensus frameworks equals consensus blindness. If everyone uses the same lens, no one questions the lens, but also the lens no longer has much of an edge because everyone's fighting over these little breadcrumbs. Whereas if you can spot something that all of them miss, you essentially bank on the big moves of all of their positions unwinding, which can produce a bigger move. That's not always the case, but just as a kind of rough idea. They must quantify everything, so they ignore what's not quantifiable. So if it can't be measured in a spreadsheet, it gets dismissed. Examples of ignored catalysts: viral social behavior, Peloton, Crocs, GameStops. These would be things like Chris Camillo does. He's a really awesome investor, someone I look up to a lot, who uses social information to basically spot trends and spot companies' earnings or narratives before they actually happen. A big influence on the way that I do things. Second thing is cultural shifts like AI hype, ESG narratives. These are things that are new to the world, and therefore how on earth could a model, we don't have any numbers on how it's going to look. And so the type of information we look, whilst we can still use numbers and get numbers, it has to use a level of human judgment to be like, oh, okay, this makes sense. I see this happening. Essentially, it's the study of cause and effect. If you are not relying on pure mathematical models for everything, you are relying on that stream of cause, effect, and that chain. And that process is really exciting to me. Maybe it's exciting to you as well. And I'd love to show you with this channel how that works and how that chain can actually develop, because that understanding that and being like, oh, this leads to this leads to this, that's actually really exciting. And my goal with this channel is to make videos where I'm going through that process. Obviously, I know we're talking about theory now, but where I'm going through that process and showing you exactly how I do that. And then finally, belief changes. So recession fear versus soft landing optimism. Ultimately, most things come down to belief. People believe after they see data, but if you can believe before you see data, or specifically before the main data comes out, you can still look at data, but smaller things. Like, for example, if you're looking at comments on social media and, you know, buzz from certain influencers that are specialized in a niche, that's technically data, but that's data that everyone else ignores. Therefore, it's still really, really valuable. Whereas really what you're trying to do is beat the data that everyone else is looking at, the ones that the models look at, and revamp. But even if you do that, you know, there's still a bit of an edge. It's just much smaller. And so the markets move on belief before they move on data. This is key because everyone always assumes data, and they want all the security in the data. But the irony is you actually have, whilst you have more security when you just wait for the macro data to come out, you also massively by orders of magnitude reduce your actual risk. Reduce your potential returns. And so institutions only act when data shows up, which is often too late. When I say too late, I don't mean that it is too late for anything. There is often some drift. There's often other things that can be taken advantage of. I'm talking about those high conviction, bigger moves where you have more confidence, and you can kind of, at least I like to kind of position a little bit more heavily into those. That's the type of conviction that I'm talking about, type of positions. Anyway, next one is career risk versus investment risk. Large funds are not optimizing for just returns, specifically the employees within these funds, but also the funds. They optimize to not get fired. Okay, this is really important to understand, because I think a lot of people think that a lot of these people, these funds, are like these, you know, mathematical like predictors. They're sitting looking at the world going, okay, I see this is going to lead to this. But they have a lot of steps that they have to go through. They have a lot of things on their mind in order to make sure that they don't just win. They also have to not lose. They also have to think about, okay, their job and their career prospects. How would it look if they got, you know, fired from this company for not doing very well and being that guy that was always going against consensus? You know, that's a big risk with people. We're all human. And when you've got things on the line, especially if you've got responsibilities, a family, any human being is going to be really, like, you know, not keen to go against the norm and to risk it all. Not everyone is really, you know, obsessed with risk. Maybe you are, but if you are, you're in the minority of people. And so what does this cause? Safe consensus trades instead of early contrarian trades, again, which reduces a huge part or aspect of a bigger edge. Needing confirmation from multiple sources before acting, being late on purpose, better to be wrong with everyone than wrong on your own. So again, these are just human psychological factors that are all coming into it. And so therefore, they can't buy early. I'm going to bold that because it's important. They can't buy early, and they can only buy when it's already obvious. But when it's already obvious, it defeats the whole point of those big moves, which is you want to be right when most other people are wrong. And the bigger that distance is, often the bigger the edge is. This is why insider trading is illegal. I have a whole video on this, but that's the reason it's illegal, because if you know something that no one else has access to that's really important, like for example, you work at a big company that's publicly traded and you know that this earnings is going to be huge, but no one's talking about it, and you put 100% of your account leveraged up, you know, massively on beating earnings. That's an unbelievable advantage. That's where the biggest edge is going to come from. So much so that it's so unfair that they've made it illegal. You can even go to prison for insider trading. And so whilst we obviously don't want to do that, taking the same premise to understand, okay, well, if that's where the biggest edge comes from, then can I replicate that in a legal way? Meaning, can I get information that's really important, really market moving, that other people either can't see, but realistically, most of the time it's going to be the second category, is that they can see it, but they discount it, or they don't want to take the risk, or they don't have a way to kind of feel safe with doing it. That's where most of the big edge is going to come from, and that's why I focus on that on this channel. Anyway, they confuse correlation with causation because they rely heavily on regressions and statistical fits, again, with models. An example would be rates going up, stocks going down, false in many cycles. Strong job reports equals good for markets, often the opposite in late cycles. So all this is really saying is it's saying that the way that data is interpreted really just depends on the overall context. And often these models will miss out on that because they're just looking at things from a purely mathematical cause and effect perspective rather than taking into effect broader context. Another example would be low volatility equals low risk. Again, before 2008 was an example of that, before everything collapsed. Belief, if it correlated in the past, it will in the future. This is the same belief that technical only traders have. I know because I spent a huge part of my career trading, and it was mostly technical trading for many years. I'd say the first like 4 years, maybe 5, before I even looked at anything else. And so the reality is that structure changes, correlations flip, and models break. Some of the biggest traders ever have always spoken about this, investors, traders, whatever. Warren Buffett, be fearful when others are greedy. Obviously, he's very long term. George Soros, I can't remember the exact terminology he uses, but it's essentially banking on the fact that models break and that models are prone to making huge errors. That's his whole thing. So just 2 examples. I'm sure there are loads more, but I can't think of any. They don't adapt fast. Model inertia. So updating models takes meetings, committees, risk sign-offs, backtesting, approval. By the time they adjust the model, the narrative has often already flipped. Again, it's kind of similar to the previous points, but it's really important to know. So examples, every bank stuck to transitory inflation for 12 plus months, and soft landing persisted long after leading indicators turned. Retail narrative investors can pivot in hours, institutions take quarters. This is another huge thing because just this little thing alone, the fact that we can get in and get out, presuming we've kind of mastered the psychological game of investing and we're not kind of FOMOing in and all this sort of stuff, like assuming you can do that, just there is an inbuilt advantage in terms of the speed that we can get in to something. And really leaning into the advantages that we have, more specifically the weaknesses that the others have, that's going to be one of the biggest reasons for an edge. And this is really what the whole premise of what I do is based off of. Next one is an interesting one. It's ignoring second order effects. So models tend to models tend to capture first order logic. So that would be something easy like this has happened, which directly means this is going to be affected. A company's had bad earnings. This is going to be bad for this company. Very easy. But it often misses that the knock-on effects from that. So for example, let's just say a tsunami has come out in Japan. The initial effect might be like, oh my God, this is going to be really bad for the overall stock market or whatever. Maybe a little nuanced one would be that rebuilding contractors of building companies will begin to go up because they'll obviously need to rebuild, which means money is going to go into those companies. That would be an example of a second order effect. And it's very easy to miss those. Example, rate hikes to cool inflation, first order. So rate hikes is just basically saying that interest rates going up, which they do to cool inflation. But a rate hike can also destroy regional banks, which can kill credit, which can equal recession. There's lots of orders of magnitude that first and second order effects can have. Essentially, it's just about understanding the cause and effect chain and understanding the time horizon that's probably going to take to actually occur. There's lots of ways to do this. I'm going to have a whole series dedicated to just looking at identifying the cause and effect chain. If you're interested in seeing that sooner, let me know because I can bump it up in my schedule of making content for you. So key kind of insight there is that second order thinking requires human judgment and narrative mapping, not spreadsheets. Doesn't mean you don't use data. It doesn't mean that you don't look and research and really do your due diligence, but it does require a level of human judgment. There is an element that needs to be done by a person with this. And models are mathematical. So yes, there are humans operating them. However, they are largely kind of fixed and kind of clunky and slow to adapt. The next one is that they often, this is not always the case, but they assume that the market is rational. So the classic institutional belief is that price equals discounted future cash flows. especially with stocks and things like that. So that means that they tend to dismiss things like emotion, feedback loops, and reflexivity. Now, I've spoken about reflexivity a lot on the channel so far. I'll leave links in the video below if you want to learn more about it. But it's essentially the idea that price can temporarily detach from fundamentals. So for example, if we have some news that comes out, prices start moving up. At this point, we get more and more media coverage. More and more media coverage, which means people are even more excited about the stock or whatever it is, and they start buying more. Because it's going up more, it gets even more media coverage. People feel even more happy with it and comfortable with it, so they buy more and more and more and more. And eventually it just creates this thing where price itself is actually fueling further price until a point where the narrative dies. People realize, oh God, fuck, this is a bit overextended. And then it tends to revert down, or in some cases crash all the way down. That is the main idea of reflexivity. It's a concept that George Soros, I believe, came up with, but it's something that is a big part of the way I look at the markets, especially on this level. And so just to kind of summarize what I've put here, price moves, behavior changes, fundamentals change. Example, tech bubble in 1999, irrational, it must revert, but the belief itself created new realities, mass adoption, capital inflow, infrastructure. In other words, the belief was the mover. The belief actually managed to move things more than what the rational thing would say. Crypto is another one. At face value, like Bitcoin isn't really worth anything because everything else in the past, it's like it's been tangible. You can either hold it or you can measure it. Bitcoin, yes, you could measure the supply, but it was totally new. It was based almost entirely on belief. And yet missing that, just having known Bitcoin and really being like open-minded to it, researching it, understanding, tracking how the belief changed over time, that's a classic example of where leaning into the irrationality of people and belief and narratives and belief cycles, all the things that this channel is based on, provided probably one of the biggest opportunities in, the last 10 years, the last 15 years or whatever it is. So narratives create fundamentals, not the other way around. This is not always the case, so this is a bit of a blanket statement, but for the most part, narratives can drive fundamentals. Next one is that they only act when evidence is statistically significant. So this is kind of similar to some of the previous points, but the markets don't wait for proof. They are often based largely on belief, and by the time something shows up in indicators like GDP, EPS revisions or whatever on stocks, CPI, employment, all these sorts of data points, they're great, but the trade is often 80% done. Again, leaning into what I said earlier about the bigger the edge comes from the biggest distance between what most believe and what you know to be true. So in other words, institutions need evidence, narrative investors only need directional pressure and belief shifts. So if you understand mass psychology, if you understand belief shifts, if you have an idea of the fundamentals, but you are understanding that your time horizon is based on belief, often it can provide some of the biggest edges. And then finally, they measure risk the wrong way. This is a bit misleading, this title. They don't always measure risk the wrong way. They're often pretty good at it. But institutional risk equals volatility or deviation from the benchmark, meaning the deviation from kind of the average of what they were expecting with that particular model or whatever they're doing, right? But the real risk is being on the wrong side of narrative shift. Being on the right side of narrative shift is really going to be key, as we've discussed multiple times, so I'm going to go over that again. An example, holding bank stocks before 2008 was safe by volatility measures, but shorting them was considered risky. If you've ever seen The Big Short, this was the whole idea. Like Michael Burry went in, he was trying to, short Goldman Sachs, all of these places, and everyone laughed at him. They were like, yeah, funny, good one, whatever. But then what happened is everything unwound massively and he was right. Now, don't get me wrong, there's probably going to be loads of examples of him being wrong, and it's easy to focus on the one where he was right. But that one where he was right, he was betting big and it probably outsized multiple losses. It's about those asymmetric returns with contrarian trading, investing, whatever. So who made money? The ones betting against the consensus. So volatility models said all is safe, and then the narrative said this is a powder keg, it's waiting to explode, it's waiting to go. So the next question, now that we kind of know this, the next question is how do we lean into this? How do we adapt what we're doing and lean into it slightly? And that's what the topic of this next video is going to be all about, somewhere here or in the description. Check it out, and I'll see you there. Take care.